Hey, Papa Trades! I'm just going to do a real quick little video. I've introduced some new metrics to my page, and I just want to establish some criteria. And I want to remind a few things, of course. Obviously, this is not investment advice in any way. Options are extremely risky, and also that this isn't in a book anywhere. This is from years, actually 2 years, just for this screen. Just for this screen. It's about 2 years of studying, and this isn't a all-encompassing summary of what I've learned, but I want to just kind of talk about smart money versus kind of sleazy money, right? Not everyone who buys lots of calls or lots of puts on a stock like far-fetched before a big news event anyway is a bad person, right? They're not all doing bad things, even if they're spending millions of dollars. And this is it's a pretty big topic. It's a touchy topic. We all kind of know what goes on. We don't like to talk about it, but I want to talk about what I think are some of these smart MMs, and I'm also going to talk about what I think are some of these scammy MMs right on this picture that we're looking at right now. The financial markets that most people, they go to work to invest in this financial market, right, in their 401k, right, that free money match, right, for their free market. We're going to talk about how true that is for some of these. So let's talk about some scammy options activity. What's some scammy options activity? I think that this one right here is just the textbook example. The Atlanta Braves. This is very scammy. Let's just look at this. 1,649% increase in call. First off, increase in options volume. Sorry, let's make sure we know what we're looking at. So this right here is the percent change between today's total options volume and the 1 month average total volume. So the Atlanta Braves actually have a corporation, right? People think sports aren't rigged, and the Atlanta Braves have a you understand that if someone has a corporation, they are legally required. They have no other legal responsibility. But to return and maximize value for shareholders. So you understand what you're looking at right now, right here, guarantees you, no matter what, that the Atlanta Braves have to be participating in rigged sports. They have to be. You can't be a corporation and say, no, we're going to be about fairness. We're going to be about doing the right thing. Go be a corporation right now. Go start a corporation where you're going to do the right thing. That's called a nonprofit. If you're a publicly traded corporation, you cannot say you're about doing the right thing, fairness, having the best baseball team, none of that. You can't even say winning games is your biggest priority. No, it's not. No, it is not. If you are a corporation, you are a publicly traded corporation in the United States, you cannot say winning baseball games is, no, it's not. Hell no, it's not. Go have the CEO of McDonald's say winning baseball games is his number. No, he can't say that. No one can say that. No one with a ticker on any of these tickers that you can go buy a brokerage can say that their number one priority is winning baseball games. They for damn sure can't. They definitely can't have that in the prospectus. Anyway, let's look at, and that's just my opinion. All right, I'm not a CFA. But let's just look at this. First off, I mean, the stock analysis, this is really just more about, like, maybe this guy's a wave theorist, right? Maybe he's a value guy. Maybe he's seeing something like this, right? I mean, that's nonsense. We'll look at what he bought. But when the Braves have some announcement, I mean, this is, like, do you really think that this guy filed today that he bought? Like, there's no way that someone filed that says they bought this. Maybe they did. I haven't checked the K1s or whatever. Maybe they did. but we'll look at what this guy bought. Maybe, like, this is just kind of weird. So if we hear a big announcement about the Braves, we're going to return to this video. Baseball fans, you know, how do you script a baseball game? I think the Braves are about to show us. Maybe he's a wave theorist, right? We'll see. Let's look at some of this exposure this man bought. This person, who knows? Maybe this robot, it probably wasn't a person. Yeah, actually, this looks like a person. All right. He didn't buy, he was smart enough to buy 2 months. A lot of these people just buy 1 month. 6,900. First off, let's just go back over here and look at this main window. Not a single put was bought on the Atlanta Braves today. 7,200 calls were bought. And 6,000, they're all right here. You can see them. 6,900 of them were about 14% out of the money. $55 times 6,910. This man bet $380,000 that the Braves Corporation is going to go up 14 or 15% in the next, in the next, what? What's it say? 58 days? 2 months? Okay. Well, the options market is telling him that he has about a 60... What's that? He has about a 66% chance that the options are going to expire worthless. That's what the options market is telling him. He bet $380,000. He might know something that says otherwise. The best bet is that that's Elliott Wave, right? He's going to hold that low and go higher. Okay? Let's look at another one. We'll talk about some good ones. Grocery Outlet Holding. Let's look at the stats for this one. Unusual stock options. 1,180% increase in 30-day average volume. Now, just as a side note, I prefer that the IV rank be on the lower end on the list. That's a preference that I have. Why? Because that's going to help refine the expectation and kind of guarantee these options are being bought, not sold. Anyway. But on the other hand, if someone's clearly buying options and the implied volatility rank is rather high, it also makes it kind of more unusual. Let's also get rid of another criteria. What about this stock right here? Compugen. But puppy trades, Compugen 1,100, that's pretty big, right? Well, Compugen is also up 173% today, right? So it's not really unusual that, an unusual amount of options were bought on a stock that was up 173% that day. When a stock like Grocery Outlet has barely moved at all, and then it gets big interest, 1,180% interest. That's a little interesting. Now let me just kind of ramble about some option market dynamics. Okay, I didn't write the book about option markets, Greeks, and I certainly didn't write about liquidity. But let me say, a pretty common piece of advice people get is to avoid illiquid markets, especially illiquid options markets. I'd say that's generally true. And this definitely is not investment advice. This is just something that I've come across because I trade options on a basically weekly basis. I'd say that's basically true, but it's important to understand that stocks that have less liquid options markets can give very interesting hints, because less liquid options markets are kind of the ones where the unusual options volume, especially if there's a lot of evidence it was bought, like if IV rank was very low, it's kind of more evidence that the unusual options volume is actually going to result in the move happening, right? Because every option needs a seller. There needs to be a market maker. And so what I think is happening, in my opinion, just to be a little frank, is that when these extremely large orders for illiquid strike prices are hit, an option seller, some poor option seller is being caught off guard, by an MM. Whereas this can't really happen, with stock like Facebook or Tesla or, I guess on an extremely large scale, it could, where MM could just come and abuse an option seller. But for less liquid stocks and there needs to be a market maker, and this is something that can happen in the futures market. I think it's actually going to be a pretty big it's going to be a pretty big theme actually in 2024 when futures markets, particularly for commodities, have illiquid strike prices and we have gaps in the futures. That's where we can see some crazy moves happen. If you can believe it, Redditors actually didn't move the price of silver and platinum and platinum and palladium and cotton and copper futures and stuff like that. That's something I'm looking for. If we had a big gap in the futures market one Sunday night, that would be a possible, silver squeeze situation. Anyway, that was a tangent. Let's look at the exposure that this person bought for. So this person, 2,621 calls, it looks like were bought. So let's just go back to the unusual stock options volume for Go Grocery Outlet. 3,572 calls are what triggered, the unusual activity. 2,600 of them were bought for the 30 strike call. Now, the 30 strike call, that's actually pretty far out of the money, especially for options that expire in 30 days. So does this person know something? We'll see. Let's see. 30 days are the expiration. They bought 20. They were $27 a piece, so they're pretty cheap. And let's see. They bought, just for this expiration, 2,621. They spent about $70,000, and they bet that this stock is going to go. They bet about $70,000 that this stock is going to be, basically 7 or 8% higher, in the next 30 days, which that's a pretty bold bet, that's a pretty bold bet. The options market right now is saying there's a 79% chance that they just wasted 70 bands. They also spread it out a little bit. 884 options for the same, so 7 or 8% out of the money again. This time they bought 884 options, so that's times 55. That's about $48,000. So in total, someone bet about $110,000, $120,000 that this company is going to be above 7 or 8% in the next 30 to 58 days. Okay, so we look at the chart. Maybe they're bullish commodities, right? Let's forget about this stock. It's a high growth, extreme value retailer, right? So maybe this person's playing in a recession. I'm personally looking at some of these. These staples, and maybe they're just bullish to staples. The price to sales is 0.80. That's a pretty cheap. And the stock is pretty profitable. Especially if, we don't, the interest coverage ratio is very high. Return on assets pretty high. This person might just be really bullish, right? We don't see the institutional shareholder. Yeah, it looks like it's a good stock. It's a high growth, extreme value retailer of quality name brand consumables and fresh products are sold through a network of independently owned and operated stores. Fun treasure hunt shopping experience. Whoa. And an easy to navigate small. Where is this place? California. Emeryville, California. Is that by the Yay area? Anyway. Yeah, they might just be bullish, right? And maybe this person is reading recession, stuff, right? They're reading recession stuff. They think we're going to, have a dash to the Dollar Generals of the world, which I'm pretty sure. I've seen some action in the staples, so I don't think he's just some retailer, though, that's bullish to stock and, betting his salary. I think that, um, you look at this. He might be a wave theorist, but he's not a wave theorist with time. So that's the thing. He's definitely not a quant. I think a quant would have bought more time. So we'll talk about what he might be. Is it scammy? We'll see. I'll talk about what isn't. Because I don't want to. We'll talk about some maybe less, sketchy activity, and maybe a more. Because the other thing is that, it's not just that. We'll talk about why this is sketchier than maybe other activity we'd see in the options market on some of these dividend pairs. I got 3 dividend pairs. We'll talk about exposure calculations with these stocks. But this, we'll see. It'll be really interesting if we get news from the Atlanta Braves and this grocery outlet that are specific. Maybe this is just the MM who was like me expecting a rotation into some staples or commodities related names at some point. In the first half, probably the first quarter. So we'll see. Yeah, I mean, while it's above, that would be pretty tight. 25.71, that'd be pretty tight too. Yeah, I mean 25.71. We'll see. 25.71 would be pretty tight. 23.69. That actually sounds just right. That'd be a little more meaningful of an invalidation. But this person wouldn't even have time. I mean, this guy needs it to go up pretty fast. So we'll see. It'll be interesting to know what happens to this fella. No, so let's say that these stocks both go bust, right? Let's say that these stocks both go bust. We wake up February 16th, the options were worthless, right? Does that mean this type of analysis is worthless? The answer is no. What could be going on? Well, for this stock in particular, what could be going on is that, believe it or not, some people have extremely, extremely large pockets. And there might actually be someone who has so much money that they want to invest, and we'll talk about exposure calculations with these next 3 stocks. They want to invest millions of dollars in this stock. And so these calls are literally them buying time, because over the next month to 2 months, they're planning to move money into whatever their account so they can buy this stock and start a campaign. But if this stock runs away, then they can't do that. That's why they need to buy these options. And, so it sometimes what can happen is it'll go bust. Everyone will say, oh, like the options analysis was worthless. But then because those options expire and that person's campaign was able to end, then we see the move right after the big expiration. So sometimes that can happen. Sometimes it never happens at all, right? The Atlanta Braves guy, we'll see. He needs a 15% move in 58 days. I mean, we'll see. We'll see how scripted sports are. I'm interested. But let's look at this guy, Altria. Maybe a little more. So these guys have been betting a lot of money that we're going to be smoking cigarettes and, whatever pretty soon. Altria, let's look down here. So it's a little less useful analysis with Altria because we're talking about a very liquid stock. But even so, 1,000% higher than average volume. And we got 450,000 calls to 32,000 puts. If we look at these options on Altria, we can see most of these options are very in the money. So that's a little interesting. Altria is obviously a dividend king. UVV, Universal, also, what's the other one? Philip Morris. Very similar theme. I think that this was the weird options activity that they bought. So this was, they spent, this is millions of dollars that's being looked at right here. So let's just do one of these and talk about what these positions are. So we just look at what was unusual. It took about 400,000 calls to make this, unusual options. So we don't know, that it was specifically this person who did it. We don't know that both of these options are the exact same person, but I think that this is a really interesting way this is a pretty interesting order right here. Let's just talk about the exposure and how much money was spent here, and maybe why they spent it. This is Altria. Let's remember, Altria is a big time dividend payer. So Altria's total returns for dividend investing right here for the past 10 years are below 7.19%. Not terrible, especially considering, maybe not the best time, to be in the staples during that, very aggressive tech bull. Anyway, where were we? Yes, Altria's Greeks. So let's just look right here at this $40 call. So it was $245. Notice this call is very deep in the money. So the first thing we're going to do is we're going to calculate the intrinsic value of this call. We're going to assume that these calls were bought at the very, very last minute of the day. Obviously, there's no way to know that. So if they bought this call the very last minute of the day, that means that the 40 strike call, if they actually bought this for $245, that means that they bought this for $245 and it has an intrinsic value of $245. Why is that? Because 42.44 minus 42.44 minus 40, I got my calculator here, is 2.44. So if they actually paid $245 for each of these 40 strike calls, well, that means they really only paid $1 in time value. So even if, this might be a little more responsible of an MM. Maybe this isn't a shady MM. Maybe he might know something. He definitely might know something. But this is a little more responsible and less shady, in my opinion. Why is that? Because he basically only paid intrinsic value. If he's really bullish Altria, 42... Right now, bar chart's got Altria's yield at about 9%. So 42.44 divided by 40, we'd potentially be seeing, Altria's yield go up, 5 or 6% if Altria fell below his strike price. And he might be perfectly happy with buying those commons if that happened. So if he's really bullish, this might be a little more of an exposure play. What's the problem here? Well, he's not getting any dividends holding these options, right? So that kind of gives the hint he might be looking to exercise these, or he might be worried that, the stock's going to run off without him. Let's calculate his exposure for a sec. This is what's interesting about options. I'll never trade options ever. Okay, well, this might not be the best example. Let's just look at his exposure. 101,041 contracts were bought, and they were bought for $245. That means he spent $24 million. He spent $24,755,000 on these contracts. Now, how much exposure did he get? $24,755,000 is what he paid. Well, we can see the delta is 95. So if we say 95 times 101,041, then we see he got $9,598,000 worth of exposure. So that's not really, I don't see why he didn't just buy commons, but that's just because I'm retail. This person could have so much money that he's literally just buying time, and that he actually is planning on buying commons, and so he wants to move money, get this campaign started, and he can't do that if Altria runs away. So he needs 101. He needs to spend about $24 million on in the money calls. He's really mostly only paying intrinsic value. And then if we look at this position right here, assuming it's the same person, 86,000 calls bought, we'll say he got a really good fill at 485. That's another $40 million. We're looking at someone who spent $60, $70 million on in-the-money calls on Altria. They were deep in the money. It looks like he's worried Altria is going to run off. And if it does, he wants to exercise these and have money moved aside to buy them. So anyway, that might be a little more of a responsible, less sketchy MM. Now this guy I think might be the smartest. These last two I think might be the smartest and the most ethical MMs. I'll talk about why. So let's look at Apple Hospital REIT. So APLE, 4,100 calls, caused the options volume to be over 1,068% higher than the 30-day average. So let's see what they bought. We're looking for 4,100 calls. This stock pays a 6% dividend. So I think this guy actually got the best deal. Now this guy's pretty smart. So he bought 4,072. So basically this guy's entire order is what caused the options volume to be over today. This is a very interesting trade right here. Well, let's do the math here and talk about how powerful options can be. So right now, Apple Hospital REIT is below his strike price. Let's talk about how far below his strike price is. If Apple Hospital REIT, let's see, assuming he bought these at the very last second, which we don't know. So they're only 3% out of the money. Not bad. Not too bad. So he bought 4,072. So this could definitely be a whale who is worried that Apple Hospital REIT is going to run off, and he knows he wants to exercise them. But let's talk about how much exposure he got. First, let's talk about how much he paid. 4,072 times 20. Times 20, $81,000. Nothing crazy. He's taking advantage of a less than liquid market, though. So he spent $81,000. But how much exposure did he get? This is what's very interesting. He spent $20 in premium. How much exposure did he get? Well, we can see his delta was 32. So he spent about $80,000, but he got how many notional shares worth of exposure? 32 times 4,072. He got $130,000 worth of exposure. So that's actually a wise guy, not in the shady way, but in the mathematical way. And that dividend, we can see why he might be worried. Apple Hospital REIT's going to run off. Not the best, but for REITs, not a great time period from 5/19/2015 to 12/15/2023. I'm pretty sure that's outperforming most of the real estate ETFs. Horizon Technology Finance, another dividend payer. Now this one's pretty smart. This guy looked like he was pretty worried Horizon Technology Finance was going to run off. I hear a lot of the dividend gurus talk about this one. It looks like someone's worried HRZN's running away. 6,247 calls were bought, causing 1,485% increase in average volume compared to the past 30 days. 6,248 options are what I'm looking for. Horizon Technology Finance. Let's see. Right again. This one's kind of, so we're looking for 6,000 options. 3,000 of them are for this first expiration. Where's his next one? He didn't hedge, did he? I know he didn't hedge. Wow, what a bastard. Oh my God. Anyway. Oh man, what a hoe. 74 times 3,000. But look, again, 74 times 3,000. Look. He paid $222,000. But how much exposure did he get? 86.7 times 3,000. So he got $260,000, even though he only paid $222,000. So that's the power of options. How much was intrinsic? Let's see. If he bought it at the very last second, that means $57 was intrinsic. He paid 74 for these, but he got a pretty good amount of time till July. These, this is something a little interesting. But these options were they smarter? He paid less money. He 63 times. So he bought more contracts and he paid less money. He bought more contracts and he paid less money, right? But let's look at also, this is what's crazy about options. How much intrinsic value did he get? Well, we don't know exactly when he bought this. But if he bought it at the very close, he actually got a pretty good deal. He actually got more than the intrinsic value of the option. That's because if he bought it for $63 and Horizon Technology Finance is at $13.07, that means the intrinsic value was $57. So he only paid $6 in time value. He didn't get more. He only paid $6 in time value. But how much exposure did he get? Well, these options, even though he paid $203,000 for them, they have a delta of 86. He only paid $7 in time value, assuming that Horizon Technology Finance was 57 cents above his strike price. So if we look at the exposure, he paid $203,000, but how much exposure did he get? 86.2 times 3,235. He might know something, but he paid $200,000-ish for these options. He got about $278,000 worth of exposure. He also knows something about dividends and Greeks too.